So today we'll be talking about analyzing financial performance. Talking about analyzing financial performance, we're talking about production strategy, HR strategy, research and development strategy, etc. Now we'll be talking about the marketing mix. And then we will delve into information systems and information technology. So that's our agenda for today. Okay, so let's begin. So we began by talking about analyzing financial performance in the objectives. So someone may ask, like, how relevant is financial or finance issues to strategic planning? So let me throw this question to you. How do you think finance issues relate to strategic planning? I mean, you guys are training to become accountants and finance people. So why do you have to study strategy? How do finance issues relate to strategic planning? Any idea? How do finance issues relate to strategic planning?
Okay, sir.
Yeah.
So I believe the backbone of every organization is its financial strength, because if a company is not that liquid in terms of cash, though you are reporting the profit at the end of every year, but if the profit is not translating to physical cash, it becomes an issue, because every plan has a bit of financial aspect in it. So I believe finance should be regarded as a key strategic plan for every organization.
Okay. Any other ideas? Any other ideas, please? Okay. It looks like, as usual, no, people don't want to talk, so. Okay. So we know that the finance objective, as our friend said, the finance objective is normally the main corporate objective of a business entity. So that was what our friend was saying, our colleague was saying. That was a very good point. He was saying that it's the financial strength of a company that drives the firm, that drives the company. So a finance objective is normally the main corporate objective of a business entity. I mean, if the business is not making money, then why, how does it even run? Even for organizations that are non-profit, their main objective would be the availability of funds and even how they use those funds. So it all comes down to finance. Finance. Okay. The second thing is that the finance function within organizations they serve as a backbone to the entity's competitive strategies, right? So if the entity is trying to execute some form of strategy, they cannot do it without the collaboration of finance. Finance gives that strategic support. Finance gives that backbone. Finance gives that, foundation for the entity's competitive strategies to be achieved. So that's very, very key, right? That's very, very key. Now, you need to know that so that you even understand why you are studying strategy. For a lot of you, just let me know your thoughts. Have any of you thoughts about why they are making you learn strategic case study? Just let me know. If you have ever thought about why they are letting you learn strategic case study, just let me know, or say in the chat that you've actually thought about that. It doesn't seem like your core accounting stuff, but why are they letting you study it? If you can attest to that fact, just say yes in the chat or speak up. Okay, yeah, so that's one of the reasons, because the finance people are supposed to, they serve as the backbone for strategy. That's why you're learning strategy, right? If you don't learn strategy and a finance person, you are a parochial finance person. Like those finance people who don't understand things within the context of the business strategy, are not that useful to organizations. And I'll show you why they are not that useful. Because all they are doing is just doing their little accounting stuff. They don't know how it all fits into the big picture, which is the strategy of the company, right? So for instance, let me give you an example. Let's say you are a finance person, right? And your boss tells you, we need to analyze the financial performance of our company. So your boss tells you, okay, Kingsley, or is it Madeline? Am I pronouncing it properly?
Yes, please.
Okay, or Madeline. Please, we want you to, your boss says, oh, please analyze the financial performance of our company. I want you to calculate net profit for us, right? Because you're analyzing the financial performance of the company using financial ratios. So let's calculate net profit. Okay, so you do your calculation, you say net profit is simply net profit over sales, which we'll be talking about in a jiffy. It's net profit over sales. Oh, okay, so our net profit is, you tell your boss, okay, so when I calculated this, our net profit was 16 million, and our what do you call it? And our sales was like 100 million. So our net profit will be 16%. Net profit ratio will be 16%. An accountant who doesn't understand strategy, or who is just doing accounting, just basic accounting, will just stop there. But the 16%, what does it mean within the context of the business strategy? That's what we are looking for. That's what they say, the numbers should tell a story. That's what we are looking for as a finance person, as an accountant, as not just doing just debits and credits. And so that's why this is key. So for example, Madeline goes back, okay, when she finds out it's 16%, she then says, okay, why is this 16%? Okay, 16%, 16% because maybe the company is spending too much in terms of their costs. They went to get a loan and the interest of that loan is very high. Or maybe they are renting and the price of, or the cost of that rent is in dollars. And so when the dollar, when the CD depreciates, it really affects the company. So their cost is increasing and increasing. That's why their net profit percentage is at 16%. So you see here, you've placed it within the context of the business strategy, or what is happening in the environment. Or you could also say that, oh, The reason why net profits are 16%, and maybe last year it was at 20% or whatever. The reason why net profits are 16% is because maybe the organization has embarked on a strategy, and the strategy is maybe to invest more into the company in order for them to spread and go into new market areas. And so maybe they open branches in different parts of Accra, and they were renting, as part of their expansion efforts, they were renting. And so their cost for that year increased. And that's why you are seeing net profits that way. So here you are bringing the strategic context or the business context to the number. The numbers alone doesn't mean anything. So that's one thing I need you to take note of. That's why I'm taking my time to explain. Now let's talk about financial performance and objectives. The finance function within an organization provides a system for setting performance targets. So for those of you who are in the finance function, realize that one of the things you do is you prepare a budget. A budget is usually a target. It's a target. Then you measure your actual results against those targets. Then the finance function, because of this arrangement or this system, what it allows for is for monitoring and control. So you're able to monitor your actual performance against your targets. If the entity is using what we call the balanced scorecard approach, can someone explain to me what the balanced scorecard is? We discussed the balanced scorecard, I think, last 2 weeks or so. Who remembers what the balanced scorecard is? What is the balanced scorecard? The balanced scorecard. Hey, no one is minding me. Hey. What is the balanced scorecard? Wow. Please, if you know that, let's speak up. Somebody says a strategy used to track the performance of staff. I see. Okay, anyway, we've already talked about it, so you can always go and check it. I won't repeat myself. So if the entity uses a balanced scorecard approach to certain objectives, then performance should be measured against the targets of performance for all the 4 aspects of the balanced scorecard. In our previous lectures, we talked about the 4 aspects or the 4 perspectives to the balanced scorecard. So I'll then treat you to go have a look at that. Any questions on that? Any questions? Okay. If there are no questions, then let's talk about analyzing financial performance. In every organization, you want to assess their financial performance. And one of the key ways you use to assess the financial performance of a company is through financial ratios. That's one of the key strategies that you use to analyze financial performance. So there are a lot of financial ratios, but typically, you might be required to analyze the following. So please take note of the following. There are a lot of ratios there. There are so many, but typically you will be required to analyze the following. Number one is the annual. I think in some of the past questions, I've seen annual sales growth. So the annual sales growth is something that you'll be required to analyze, right? So when you're analyzing sales growth, you can divide it into two. You can have sales volume growth and sales price growth. So what is sales volume? Sales volume is simply sales quantity, the quantity of sales. So how do you calculate annual sales growth? So you look at the sales in the previous year compared to the sales in the current year, and you see exactly how much growth has taken place or how much decline has taken place. They also have the gross profit ratio and the net profit ratio. So the gross profit ratio is simply your gross profit divided by your sales. Your gross profit divided by your sales. And your net profit ratio is your net profit divided by your sales. Very, very simple. Very, very simple, right? Very, very simple. So what does the gross profit ratio mean? What exactly does it mean? So when we say gross profit ratio, we are simply saying that for every 100 Ghana cedis, so for example, if the gross profit ratio is 10%, right? It means that for every 100 Ghana cedis sales you make, the gross profit you make on that is 10 cedis. So 90 cedis is all going into costs. 90 cedis is all going to some form of direct cost. It's going into direct cost straight. For net profit ratio is net profit over sales. So if your net profit ratio is 10%, it means that for every 100 Ghana cedis of sales that you get, you only make 10 cedis in net profit. So the 90 is going into costs. That's how you look at it. That's how you look at it. I hope it's clear. If it's clear, please let me know.
Yes, please.
Okay. Then you have the ratio of expenses to sales revenue. Okay, so let me talk about this. So why do you think we calculate the gross profit ratio? For what I said, why do you think we calculate the gross profit ratio?
So can we say that we find the gross profit ratio to know the proportion of revenue which we are putting into our direct costs, or virtually our costs used in the production of a specific of goods and services, or provision of services?
Fantastic. That's it. That's exactly why we calculate it. So we want to know whether we are actually, bleeding when it comes to our costs. Are we bleeding when it comes to our costs? That's what we want to know. So that's a good one. Okay. Then let's talk about the ratio of expenses to sales revenue. The ratio of expenses to sales revenue. And what is this all about? What is this all about? A typical example of this would be the ratio of marketing costs to sales revenue. We've said that when you spend on marketing, you would expect some benefits in terms of revenue. You expect some benefits in terms of revenue. True or false? Yes. So sometimes you would want to know your marketing cost to your sales revenue to see. So if your marketing cost to your sales revenue is 50%, that's actually high, because, or 60%, 70%, that's actually high. You would want to spend little on marketing and get the maximum return when it comes to revenue. the maximum return when it comes to revenue. So that's something to definitely keep in mind. So that's, and it could also be the ratio of administration costs to sales revenue. That's also possible. They also have the total borrowings of the business entity. Here you're looking at the capital structure, right? So things you can measure here, the financial gearing ratio. You are looking at how levered, or is the company leveraged? Does it have a lot of debt in its capital structure? So that's what the gearing ratio is measuring, right? So the gearing ratio is usually, the formula is debt over equity or debt over debt plus equity, depending on what they tell you to use. So that's basically it. That's basically it when it comes to total borrowings. You could also measure total borrowings by, you can also measure total borrowings by the ratio of interest costs to sales revenue. That's also possible. The interest cost to the sales revenue, that's also possible. They also have the ratio of non-current assets to sales. The ratio of non-current assets to sales. So here you're looking at how efficiently are non-current assets being used to generate sales. How efficient is it? The next one is the ratio of inventory to sales, or the average inventory turnover time. And it shows us how effectively we are using our inventory. And then you have investments in innovation, or R&D. Very, very, very important. Very, very important. So please take note of these 1, 2, 3, 4, 5, 6, 7. I call them the 7 strong indicators for this paper. For this paper, there are plenty, but please take note of these ones. Okay. Now let's move on to financial analysis and strategic analysis. Financial analysis and strategic analysis. Like I've always said, you should always try to put your financial analysis into the context of business strategy. You need to put your financial analysis into the context of business strategy. Very, very important. So you should know the trends that are affecting the business strategy. You should know the trends that are affecting the business strategy. That's extremely important. That's extremely important. That's extremely important. So, for example, falling unit prices might be part of a strategy to increase market share. You know, so when you see prices are falling, and you don't understand the numbers, you might think that there might be something wrong, but it's actually part of the strategy. You know, it's actually part of the strategy. It's actually part of the strategy. So that's something to take note of. Also, you need to also, so you place it in the context of business strategy. You also place it in the context of the product's life cycle, right? You place it in the context of the product's life cycle. Very, very important. So the rate of growth in sales volume, profitability, and investment in R&D can all be indications of the current position of a product in its life cycle. So if you see investment in R&D very, very high, what should you ask yourself as a finance or accounting? You should ask yourself, which product life cycle are we in? Maybe it's probably the introductory phase, you know, or the pre-introductory phase, or the product development phase. That's why the investment in R&D is very huge. It's very huge, you know. So that's something to be aware of. So I said here that, for example, little or no growth in annual sales and a high net profit margin could indicate a product that is in its maturity phase. You know, so if a product is in its maturity phase, then you'd see characteristics as high. You see characteristics like little or no growth, little or no growth in sales, and all of that. I hope it makes sense. Please let me know what you are thinking. Does anyone have any questions?
Sir,
Yes.
but can also a high R&D ratio signify the maturity of a product where they want to diversify into a new product?
Yes. So here, there's no right or wrong answer. There's no right or wrong answer. What we are saying here is that always understand the context. You know, so for example, companies might want to diversify in their maturity phase by even redesigning the product. So redesigning the product might even call for some research and development. So you would always want to understand. You always want to understand exactly. You always want to understand exactly the context. The context, like I always say, the context. Very, very important. I hope I answered your question. So that's a good one.
Yes, sir.
Fantastic. Now let's talk about resource allocation. Resource allocation. Another role of the finance function is to do what we call allocate resources. They must allocate resources. What finance people do is that they obtain the funding that is required for the implementation of strategies. So we all know that funds are limited, right? For example, maybe you might have a lot of things you want to do, but the funds are limited. Maybe you plan that you take ACCA, CIMA, CFA, CIT, but the funds are limited or the resources are limited. It could be time as well. So because there are different investment opportunities, there's a limited amount of funds. The finance people come in to basically, the finance people come in to allocate those resources effectively. So that's one of the functions of a finance person. The reason why we are talking about all of this is because it will become necessary. So for example, when I'm looking at a case study, you would want to look at who is the finance person. You see the one we were analyzing the last time, we're trying to find out if the people had the skills to be able to function in that capacity. You'd want to know that as well, right? You'd want to understand that. So that's very important. So you look at the background of the person, how the person have a strategic context to the issues. Now, what is the role of the accountant in business strategy? This is a discussion question before I even dive into it. What is the role of the accountant in business strategy? What is the accountant's role? You've discussed something similar, so I expect answers. What is the role of the accountant in business strategy?
So, can we say that in the beginning of, let's say, the lecture, you made mention of the balance scorecard. So you realize that balance scorecard is in 4 parts. One part of the balance scorecard is, and we said that the balance scorecard is a management tool which helps to evaluate the performance of both the staff and the organization as a whole. So, but the finance aspect is also one of the aspects which we can use to measure the performance of the organization or the staff. So the accountants fall under that category of the finance part, which helps in the usually through the preparation of the financial statement, which is also a measure, in more or less quantitative terms, the performance of the organization.
Okay, fantastic. So what do you think about? Do you think accountants of today understand their role when it comes to business strategy? Do you think so? After you've learned all, like, what do you think? In Ghana, do you think that happened? Please answer me. Please answer me. It's a discussion.
Well, so we can say to some extent, for where I work, for instance, it's a government institution, and they are all only known to prepare statements. When you're in need of certain items, you go to them for them to prepare probably a voucher so that you can get your funds. So the idea of they being part of the organization and helping to measure the performance of the organization is partly gone because they don't really understand that portion. All they know is, okay, we need to spend. In government institution, when you don't meet your budget allocation, we'll see you as inefficient, and they may cut your budget allocation for the next year. So that's how I see it.
I see. Wow, that's interesting. So if you don't actually spend a lot, you lose in the government space.
Oh yes, you lose heavily.
Hey, how is that? How is that even possible?
Well, because you are given an amount of money to spend. So if you're not able to spend it, they'll see that, oh, actually the money was too much for you. So the next time they'll reduce it. So in order to avoid that reduction, that is why.
Oh, wow. That's interesting. That's very, very interesting. Okay.
And so I think, hello.
Yeah, hello.
Yeah, and I also think that the accountants, one way or the other, will understand their role in business strategy, because I think for now the accounting job has moved from that kind of